Welcome to our video on debits and credits. In the last video, we discussed the four main types of accounts: assets, liabilities, revenues, and expenses. In this video, we are going to discuss how debits and credits impact these accounts. Against popular belief, debit does not mean minus, and credit does not mean plus. Debits and credits change depending on the type of account being used. Debits increase assets and expenses, while credits increase liabilities and revenues. Accounts have either a normal debit balance or a normal credit balance. Assets have a normal debit balance. What this means is in order to increase the balance in your checking account, you need to debit it. To reduce the amount in your checking account, you credit it. Liabilities are the exact opposite. They have a normal credit balance. To increase the balance in a liability account, you credit it. To decrease the amount in the liability, you debit it. Revenues have a normal credit balance. To increase the balance, you credit it. To decrease the balance, you debit it. Expense accounts have a normal debit balance. To increase the balance, you debit it. To decrease the balance, you credit it. So, if you're wondering, why do I have a debit card that decreases my bank account? Or, why when I go to the bank and make a deposit, do they say they are going to credit my account? Doesn't debit mean minus and credit mean plus? Here's the deal. Your bank account is an asset to you, but your bank account is a liability to the bank. It's money they owe you, and eventually they need to pay you back. So, from the bank's perspective, if you are making a deposit, you are increasing the balance in that liability account, which is a credit. If you use your debit card, you are decreasing the amount of money they owe you, so it's lowering their liability account. For simple fund accounting, check us out at www.iconcmo.com.